Good afternoon. Welcome to the Cboe floor. I'm Oliver Renick. This is Chicago Future of Finance. And today we've got an interesting session, I think. May not look like it on the surface. S&P has only moved a couple of points, but I think those are very crucial points. Yesterday we talked to Brent Kochuba, Spot Gamma, about the potential resistance around 68.55, a pretty big gamma wall that if the market could push through, could then release potential energy to the upside. Today, semiconductors are looking pretty good, but crypto markets are looking pretty weak. MicroStrategy is down quite a bit. So we'll see how we close up right now. The VIX is at 17.5, and now S&Ps are slightly red, down 1.6. So we're losing a little bit of our edge. This is a day that on the surface looks like it could be pretty quiet, but I don't think it is at all because there are a few big things that are happening. One of them is that it looks like the government's going to start operating again, which is very important. I think basically the easiest way to explain the moment of weakness that we went through is that the government essentially was engaging in effective layoffs. Remember when Trump first won, he said they were going to lay off tons of people at the federal level, and it didn't quite get to some of the highest expectations of the Doge program, et cetera. But when you have the government shut down for a record number of days, that's effectively, those checks aren't coming in. So those are effectively short-term layoffs, and anything that's economically negative stocks generally don't like. So with that point, I do think that when you look at some of the betting markets, you get some really interesting information right now. The betting markets on Kalshi are looking at two important things. One is the government shutdown and the number of cuts. The other is technology and AI. There's a few things I talked about yesterday that are crucial in that conversation. A big one is that AI is what's powering us. The SMH is probably the most important mover. I think the government stuff is pretty straightforward. You get people back to work, you open things up, and then you still have the Fed ready to cut behind it, and now they've got even more reason to cut because people didn't get checks for 45 days or whatever we're at right now. But if you put that aside and you think about what's working and where the strength of the market is, yesterday I talked about Google, which looked like it was trying to break out. Right now on Kalshi, the best AI at the end of 2025 is predicted to be Gemini, and that's Google. So I do think oh boy, there we go. Well, lessons learned. Gemini is the most important Google stock right now, ripping higher. The fact that you've got $286 in Google, slightly down on the day, but was trying to break out. That's the most important thing in terms of the SMH, which has been the leader. If you look at chips right now, rocking to the upside, another 80 basis point advance is just what the doctor ordered when you've got things like MicroStrategy that are getting hammered. So to come back to the two main points here. The first one is that the government looks like it's going to start operating again. That's really important because I think the best explanation for why we got hit was effective layoffs by the government by keeping the checks withheld and closed down for 45 days plus. Technically, if you want to look at what's happening on the charts, Brent Kochuba yesterday told us about the 68.55 level, which is absolutely key at this point to get through that and break past a pretty big wall of gamma that's basically sitting there. A lot of options happening at that strike. So if the S&P can get through there, it seems like potential energy that could be lifted. And so that is a very big deal. And I think that if we basically consider that as a potential resistance point to break through, then you've got a real rally on your hands. But we're having some trouble at that level today. Brant, what's up? Can you hear me, sir?
Yeah, absolutely. How you doing, Oliver?
Pretty good. It seemed like the levels we looked at yesterday, 68.55, gave us some trouble earlier today. At least stocks haven't gotten crushed, but they are hanging in, and they tried to, make a move here. Tell me what you think about the session.
Yeah, this morning it looked quite strong. The futures hit the 6,900 level, so the ES 6,900 level. And once we opened, the market sold hard. We saw negative S&P deltas in quite large size actually today. and that was about $10 billion of notional value kind of dumped on the market. And so the fact that the S&P is holding up as well as it is today is a positive sign, I think. I was reading a note earlier from Charlie McGilligan, and he points out correctly that CoreWeave has just got absolutely hammered. Their earnings were a couple nights ago. Stock's down about 20% in 2 days. And the reason we bring that up is because you're talking about the AI story. And, that's just a shot across the bow in terms of, the bullish implications there when a key stock like that loses so much ground and loses so much traction. So, to your point, we're grinding around this level. We price in about 1.5 vol points for CPI tomorrow and then PPI after that. So there's a couple of economic data points that people are waiting on. Then we're going to go into the weekend again, and then obviously those key NVIDIA earnings next week. So when I look at the way that things are breaking down at the moment, people are, I think, just waiting on the trigger, waiting on kind of that next leg. The AI story remains to be a little bit shaky, and I don't think that picture is going to change until, NVIDIA, the king, really speaks up. A couple things caught my eye this morning. Number one, we saw a big buyer or a big VIX trade, I should say. There's about 80,000 a lot of VIX calls. I know something the Najarians brought up yesterday. So there is still a lot of activity there. This looked like a roll to me, a little bit longer dated. So we're seeing some of that hedging flow shift around and position around. But, ultimately, I think people just need a data-driven, catalyst for us to make this next move. Short-term implied vols in the S&P, if you look at pre-NVIDIA, you're talking only about 10% for 25 delta calls right now in the S&P, which seemed pretty cheap. So even though we're having a hard time grabbing onto a real positive narrative at the moment, that vol seems cheap, and I continue to think that as long as we're above 6,800, that the market, the risk here is the right tail as much as anything else, particularly with the seasonals and some of the other stuff we've discussed in the last couple of days.
It's worth just coming back to this again. It's kind of been our go-to chart, which is the term structure on your volatility dashboard on Spot Gamma, which shows that spike in implied vol, that big kind of brick of options that are being traded around NVIDIA earnings, which again, to me, is just, it makes it easy for us, I think, to figure out the narrative. Sometimes it's a mystery what the narrative is in markets. I don't think the narrative is a mystery right now. I think that you had such significant closure of the government that it was effectively a short-term layoff. That could have turned into something worse. Who knows what it will, but it looks like it's going to be over. So now as you kind of remove that sort of short-term economic risk, the thing that's powering the market at its core is the earnings attached to all the AI stuff. So that's where, I don't think this becomes a great mystery. Google stock yesterday looks like it wants to break out to fresh all-time highs. The SMH had that great chart last month that ended up resolving higher. So it's just, to me, the volatility matches perfectly with the fundamentals.
Yeah, and on the macro front too, the fact that the government was shut down, it puts it messes up the delivery of all the different economic data points, right? We're getting back data now, we're getting forward data. How much of that layoffs or any sort of related poor economic data was due to the temporary shutdown? So I think that the macro picture is admittedly confusing if you are kind of a short-term data-dependent analyst, right? It's not terribly clear. And so, we have to kind of wade through that and let that clear up, I think, over the next kind of 1 to 2 weeks before I think people can really draw longer-term conclusions as to just what the macro picture is. So, again, if NVIDIA is fine and that AI story is intact, and to your point, Google looks pretty good right now. AMD was doing pretty well, but you got to juxtapose that against some of these names that are maybe losing a little bit. So it's a little bit of a cloudy picture, but again, the thing that we always have to draw back to is this idea of volatility as a major driver of alpha. And so when you have these events coming up, if they're non-events, if they're binary events, and then we go into the Thanksgiving holiday, people want to be short those options. They want to sell vol, and that really does put a buoy under the market and adds a tailwind.
Okay, I'm looking at your tape function, at seeing where the action is to that point.
Huge gold.
AMD, top options volume. Tesla
huge
right
gold
behind
volume.
it.
Mm-hmm.
Yeah, massive.
I thought about that earlier because I know you like to watch that gold sector. Gold kind of went from very rich call skews about a month ago, resettled. We had gold up, vol up. That has reset now. And that seems to be rebasing and starting to pick back up. That is massive gold volume. A lot of big trades there you can see there on the right. A lot of this is sort of a typical rolling type behavior. All the way on the right, you see largest trades. But that volume is very strong, and that sector is looking really, really good at the moment. As those call vols are starting to percolate again, they're starting to boil a little bit, simmer, and gold prices are starting to act quite bullish.
Gold, as we talked on the chart, I also think looks like it could just go right back up, just to kind of see how it dipped and then came back. Just pulling up the chart real quick for GLD. I mean, it looks like it's picking up momentum again. It was
100%.
overbought. This bottom panel here is the RSI. It was overbought for so long, September to October. And it looks like it could just go right back to that regime. Pete was trading SLV yesterday, same story there.
Yep.
So it's just, it seems like, as you put it also, barring some real strong outside force that, has to be on the par of at least an NVIDIA miss or something of the sort, it can't be just speculation or the Sam Altman haters trying to spin up a story about whatever. Now, I don't know what's really going on there, but in my mind, it's just generally if you are doing something that's changing the world and creating earnings, and creating product, and just continue to pile into it. So it's going to take more than rumors on the AI side to be that outside force. Otherwise, it looks like everything from gold to chips to the market is holding in quite well.
Yeah, and if you're going to get a stimmy check, maybe you just go to shove it in gold, and that's the safe place, right?
Yeah, right. The thing I do watch, though, that's a little bit weaker is Bitcoin and Master and some of the crypto-related stuff, which is lower.
Yeah.
MSTR looks like
Ugly.
It's going to break lower again today. How has the trading from that perspective shown up in any of the way you look at either some of these specific stocks? Because for a while, Master was ranking quite high in terms of notional options and all that stuff.
Yeah, nobody cares about crypto anymore. That's the headline. It just it was such a hot trade before.
You're gonna get me in trouble, man.
It was such a momentum trade before, and it's just died, right? Some of these other assets are more interesting, carrying more weight right now. There's more of a that momentum factor is just so big there. So I mean, you look there, you don't see IBIT or ETH.
I don't.
There's nothing in the top volume, right? So that is a reflexive sector of the market. Reflexive meaning that activity has to be there for more people to get interested to drive the activity, and it's just not, right? So people are looking everywhere but crypto at the moment, and for somebody like Michael Saylor, that's obviously a big problem, right? He's having a hard time, I think, selling the debt, and the vol of that asset has died a lot. So now he's had to go from selling bonds to preferreds and trying all sorts of other financial chicanery. So that sector is just kind of left for dead at the moment, and really not coming up on our radars at all.
Wow, fascinating. Okay, so Brent, thinking about the price action perhaps, or some of the other volatility metrics, VIX looks very calm right now. Maybe take us through some of the key levels, as right now, we're kind of going back and forth for the last couple hours here, but we are on the red side of the tape right now, just by a small hair.
Yeah, we're going to clear, again, CPI, PPI. You're going to lose 1 to 2 vol points, probably, is what the event vol looks like into tomorrow and Friday. And so, if that vol contracts, then we hit the weekend, that should buoy markets and keep us elevated. There's massive amount of open interest, just raw open interest up at the 7,000 strike. I mean, that is a giant strike, big round handle up there. And so I think that there are a lot of eyes on that strike, assuming that things are just calm over the next 1 to 2 weeks. And so that's what we're really watching. If we break 6,800 to the downside, that's still our risk off level. That's where vol could likely pick up. That's where gamma is likely to kind of push much more negatively. And so, we're right above that risk point. And if we lose that level, then I think that's the one where things will start to get quite spicy to the downside. But above 6,800 is just kind of business as usual, some churn as we wait for some new data.
The SPX gamma model, looking at your overview here, looks like a lot, that notional at 69.10. So I guess that's kind of another way to think about, if we kind of just broaden out past 10 or 15 points or so, then maybe that's another kind of break free area, or what does this part mean, Brent?
Yeah, I think at that 6,900 level, the implication is that there's a fair amount of positive gamma in that area. That infers that the market's well supported in there. So if you think about the idea of gamma as a blanket that kind of wraps everybody up, right? That starts to build up into that 6,900 to 7,000 area. That's where realized vol should start to really come down. Then those Vanna flows that are just that tailwind for the market start to pick up, right? And so we're in that area to a light respect right now, as we're over 6,800. But the market, I think, rallies sort of solidifies as we get closer into 6,900. It's kind of one of those things, like if we get 6,900, it's hard to believe we don't get 7,000.
Right, especially if it happens with leadership intact and looks familiar. familiarity in this case would be what we've been talking about, which is chips leading, gold, silver, the usual players. Now, again, maybe there's a separate conversation about whether or not Bitcoin and crypto take part, not really showing up in the options front, but I do think this is a very stock market specific move here. I mean, detaching from crypto, seeing the role of earnings and technology, all the stuff that I see on your platform, and yesterday what we were looking at on Wall Street Bets as well. We were cruising through Wall Street Bets looking for the top trades, and they're all very reasonable things. I mean, look, I don't know the way people speculate, may not be the most reasonable person to person, but it's Meta, Nebius, the one that did the deal with Meta. It's Alphabet, Google, it's Q's. So I do think that people are all kind of barking up the right tree here, and I don't think it's a great mystery to figure out which tree is growing the fastest.
Yeah, and let's not forget, I think the behavior of this market is if we start to move, a lot of people are going to pile into that move, right? It's a market that is very chasey. And so, that does work better to the upside or more to the upside to what we've seen with the buying the dip out of the recent sell-offs in October. And so, I think you don't ever want to sort of underprice the desire of people to start to kind of chase, particularly chase stuff higher, especially the thematic things that have been so strong.
I will say I do see coin up there, up and to the right, as having a decent amount of volume. That chart's kind of holding in about $300. Brent, let's go to the other side then, because I got a few comments yesterday that were like, hey, I'm not buying this move. I think we're going to break down. I've made it clear how I think about it right now. I'm generally quite constructive on stocks. Generally, I've got yellow on my risk radar, but I said yesterday I'm ready to flip that green quickly. It's just because crypto went red. I wanted to see the test. But let's say we do. Let's say we do get hit. What do you watch? How do you respond to that? What will be the levels if we start reversing?
Yeah, 6,800 is the big one. And everything is a set of if-then statements, right? If we're above 6,800, we're fine. I think we continue to trend higher. If you break that 6,800, that's where you want to start to look for hedges. Right now, vol is pretty cheap. You can buy 25 Delta puts for, pretty reasonable prices at the moment. But if that 6,800 is broken along with, say, which is impossible to believe, but maybe NVIDIA misses, right? Or has bad earnings output. If you lose that AI story and we lose that 6,800 level, that's where you start to be like, okay, this is real. This downside is real. And you can see a real vol type spasm, a shakeout to the 6,500 level, I think, with not much effort, right? Meaning it could happen pretty quickly. So, you really want to be respectful of those risk-off moves because the volatility jumps have been pretty big and violent over the last month, and I think that will, remain a key factor here. So, under 6,800, we don't want to play around, and again, it's an if-then statement. I think that we're bullish too, and we'll glide higher. But if we break 6,800, I'm not going to, mess around and say, well, I'm hoping this thing will turn around. I'm going to start looking for those downside hedges, and I'm going to resort to playing downside moves under that level.
Okay, fair enough. So you just want to see it kind of manifest itself. The other thing too, if we just kind of dilute it down to VIX for a moment, think about how volatility responded these last couple months. This most recent pullback, kind of the government shutdown, we'll call it pullback, whatever you want to describe it as, never saw volatility pop the way we did in October. When we had a real kind of static move for chips, one day of a big sell-off, some kind of tariff panic, kind of, but how does that kind of inform us, Brent, then of what volatility regime to expect?
I think the big thing that has been, we've not had a persistent selling atmosphere from, call it real money sellers or just a persistent volatility bid, right? And so if you think about a situation where, the credit market starts to falter or the AI story is lost a little bit, and that starts to put a dampener on the prospects of what's going on forward, or if you have a credit market issue where there's just demand for equity puts, that could create a more sustained volatility bid, something like a 2002 type market. Whereas right now, anytime there's been a vol spike, people go and try to harvest that volatility premium as alpha, and so that's the mentality that people operate in this market. And if you end up in a situation, again, where it's a credit market issue, banking issue, you think about Silicon Valley Bank or the 2002 scenario, or, Oracle credit default swaps, there's a whole bunch of things percolating out there. if those turn out to be real and we start to have known unknowns, in other words, risk factors that are material, then all of a sudden that ability to just reflexively sell vol to harvest any type of volatility premium, that goes away, and then you start to have stickier volatility levels, right, at higher vol levels. So that's really the dynamic that you want to be aware of. Right now, the behavior is buy the dip, sell the vol rip. And if that behavior is undone or removed due to some material risk, then the complexion of the market really starts to change.
Yeah, got to see evidence, right? Some empirical evidence. Otherwise, it's just that's what markets do. They stick with the trend. They go in the direction of least pushback, and right now that has been forward and upward. Brent, thank you very much. Appreciate it.
Thanks,
Always a
Oliver.
pleasure. Thanks, man. Good
Take care.
stuff. I'm going to follow up on the risk radar point here for a moment, just because I went through some of it yesterday, but let's do a quick little review here. The fact that you got yellow on stocks, I think, is showing up perfectly today. We're pretty much stuck. Now we're on the green side by about 2.5 points. But still, the idea here is you have a lot more pronounced weakness in crypto markets. Bitcoin is red on the risk radar for a reason. Look at again today. MicroStrategy down sizably. Master getting hit notably without even a move in the market. VIX just above 17, and MicroStrategy down 4.3%. BTC, by the way, is not awful either. Bitcoin's only down 1%. Once again, the long Bitcoin short micro trade seems to still be working. But the fact that you've got Master about to break down to fresh new lows is a pretty big violation of whatever you're hoping that company is able to accomplish. Let's look at the chart here real quick. This thing is just brutal. This is about the worst chart in the market right now. So maybe this is the market doing a self-cleaning, tidying up, chopping off some of the froth. That it certainly is what I've considered Master to be, the most levered version of crypto, i.e. the riskiest version of crypto. So I think today looks like a pretty healthy market. The fact that you can get stocks meandering while some of the frothier crypto-related stuff is getting crushed, that to me looks like a vote of confidence in the stuff that really powers the market, which is the semiconductors. By the way, that was the other big thing that I wanted to bring up. We talked about yesterday. My last point here is that the actual chart that I think was a sleeper right now, which is one of the best, is Alphabet. And the reason for why is because Alphabet's crushing it on the AI game right now. Look at Kalshi, best AI at the end of 2025. This is the chart I had up at the beginning of the show. Sorry, I was muted. Producer error. I'm the producer. This is now at 80% for Gemini. And just earlier in the spring, Google was considered behind. We talked about this yesterday because it matches up perfectly with the chart, where Google looks like it's about to break out. Flailing a little bit here today, but the fact that it's holding on right at all-time highs offers you a leader to put your hands around until you get to NVIDIA earnings. So overall, I think the situation looks pretty good. I don't know what there is to complain about unless we start to really break down to Brent's point. Maybe it's not green on the radar, but at least it's yellow for now, and I think that's shown up perfectly here today as the market goes back and forth. We're going to see how it closes up, obviously, but first we're going to have a really good conversation, a tech conversation with a really interesting guy. Jack Lynch is joining us from Ridgeline. He's working with billionaire Dave Duffield of Cornell alma mater fame. Dave Duffield was a major software innovator and a big engineering campus building at Cornell is Duffield Hall, so I spent some brutal nights there. But they're working on AI to displace some of the labor associated with portfolio management, so that should be a really fun conversation. I'm looking forward to it. We're going to take a little break here. We'll be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, let's look at some charts here. I got a few big ones that are important as we look at AI. The key story here still on the year. I think it's best represented by the SMH, of course. That's the easiest, simplest way to get direct exposure without having to pick who's going to win those races. Once again, I think that the pullback that we got over the last week was essentially just pure government shutdown fears, nothing related to the fundamentals. So here's the chart, SMH. Notice that last month, after we got that big drop on October 10th, that was the day that we saw the VIX spike also, where we hit VIX above, what did we get to? We got to 28. Okay, so mid-October was the worst that it was. But remember, semis never actually broke down. They basically sat within a range, traded sideways horizontally between 326 and 345 on the SMH. I did a little video at the time that showed this line down here, which is the uptrend line that intersected with this horizontal area of resistance. That became an ascending triangle. And guess what? The ascending triangle broke out to the upside. It ripped, it gapped, and the SMH from 740 up to 372, and that was a big move. So if we're going to pick up the pace again, that's basically your target, to go back and test the all-time highs. By the way, in this pullback that we got, that candle right there got to the same old resistance and then found support. That wick on November 7th right here, the dip below 345, that turned out to be the exact old resistance. Old resistance becomes new support. Technical stuff 101. Shout out Ben Watson from my Schwab days. Ben Lichtenstein too, a lot of good technical bins. Now, the other one I think is important is gold. We talked about it because the charts actually look pretty similar, interestingly enough. Two seemingly totally different things, but coming back up onto the old highs after falling, finding support, and testing to some degree old resistance. Because gold did chop around GLD between 360 and 370, then did the same story here throughout the last 2 weeks. Now as we push and try to break out to fresh new highs, it looks like gold's actually moving a little bit quicker than the SMH, which is pretty amazing. The fact that you've got now gold showing more momentum than the core tech sector that's been behind so much of this. I think that's pretty fascinating. I got Mr. Scott Bauer joining me, CEO of Prosper Trading Academy. Scott, what's up? Thanks for jumping on, sir.
Absolutely. Market, I would say it's kind of in a holding pattern, in the euphoria over, opening back up, the government opens back up is probably behind us now. And I think the market is really squarely looking at the bond market and what's going to happen with rates.
You think that Powell goes ahead and cuts once again? I feel like people not getting checks for 40 days probably helps the case for a rate cut, right? It certainly doesn't hurt it.
No, it definitely doesn't hurt it. And my guess is that had something to do with, the White House coming out today and said we're probably not going to get all of that October data. So it probably does have something to do with it. When we look at the probabilities now, the probabilities of a rate cut for December have gone from nearly 100% a couple weeks ago down to just about 60% right now. It certainly would make sense that they would cut, but on the other hand, we've talked about this in the past. Are they cutting for the wrong reasons, right? I mean, if we do wind up getting bad data, whether it's on the inflation front, whether it is on the labor market, whatever it is, and we hope for lower rates, are they going to cut, though, because things are already really bad? So I think we have to watch that. I do think they will cut, but what happens in 26 is probably extremely unclear at this point. And if they can't get inflation under control, that's going to be a big issue.
I'm looking at the Kalshi right now. Fed decision in December, indeed, puts it at 80%, a 71% cut. I think to your point, we could kind of sleuth through it and maybe say, all right, we haven't had any data, so are we about to get some ugly data once this government reopens? Is that what the cuts are telling us? I think that's one interpretation of what you're saying, basically, which is, the old question, are we cutting for the wrong, right reasons? I kind of think we're still mostly cutting for the right ones, but if we get an onslaught of data that was supposed to come out that all sucks, then yeah, all right, I can see that bear case.
No doubt about it. And, when it comes to this data, I was talking to someone about this morning. I think that the market is primed for this data whenever we get it to be really negative, to be really, really poor, really sobering. And if it's not quite as bad as that, Oliver, I think the market could rip higher on that, because I really think that expectation is almost like a worst case expectation. And again, the wild card in this is we don't know if or when we're going to get that data. So, we have to live with that uncertainty. But, from talking to the guys there in the S&P 500 pit, talking to some investment managers, everyone thinks, that, at least that I've spoken with, thinks that when we get that data, it's going to be pretty big.
Okay. Look, I don't see. I would think that the bias is that way, right? It's just, it's hard. We had already kind of been decelerating already. It's part of the reason why I think it's okay to cut, because the inflation situation also decelerated. Yep. But those two things generally come in hand in hand. That we went through a long period of missing economic data to the downside and just kind of a slow softening of it. Nothing that was like super concerning cracks or earthquakes, but I get that point for sure. Scott, thinking about the chart for the S&P though, I mean, if I let the technicals do the talking, it kind of looks like we're headed right back to the old highs.
No, I agree that you were just reviewing that, and again, whatever that impetus might be, whether it is when we get that data, or it's another cut, or it's just looking at the charts and saying, okay, it's time for that bounce again. I agree with you. I mean, the path of least resistance is as much as people want to say, boy, look out on the downside here. I think the path of least resistance is still to the upside. That is what the technicals are pointing to. It's just struggling a little bit right now because we're seeing such sector shift almost on a daily basis. Tech is out of favor right now, and all the stocks that people couldn't get enough of just 2 weeks ago, is out of favor. That could shift in a nanosecond. That could shift by the end of this week, and that reversal there again, which maybe that it would be the catalyst to take us back higher to those new highs.
Okay. The charts do look similar too, by the way. This kind of pullback to old resistance, find support. Like I was just looking at how the S&P looks like gold, that kind of dip and then swoop, the kind of U-shape.
Yeah.
The SMH a little bit too. It's a little bit more angular, where I think I see the uptrend more clearly without quite as much momentum as gold. So if I had to rank them, I'd have to say that I do think the gold chart does look the best still.
Yeah, and gold went out of favor for a few days, right? But the longer term chart on this, both technically and from the macro standpoint, is still a buy the dip. We talked about this for a long time. Buy the dip worked, and it worked, and it worked, and it worked. We talked about how at some point it was not going to work anymore. And many of us, me included, got stopped out on the big move, a week or two ago. However, that has really not changed the narrative yet. And until we break down, I'm looking at the charts, and you've got a really solid 50-day moving average, especially in GLD. If you're looking at that 50-day moving average, that almost hit a week, 10 days ago. It held as support. So I think we have that same buy the dip mentality again in GLD or gold right now, albeit just from a little bit lower starting point.
What do you think? Do you trade these things like high velocity, willing to spend on premium because we're going to get a big move? Do you think there is still some of that kind of meme-ified action, high frequency retail trade that is able to come power some of these stocks? Because it certainly was in the last couple of months.
There was, and I try and stay away from the, let's call it, as you just said, the meme-ified area of things, and maybe look to do something around that. I am definitely not one to just jump on the volume or jump on, how quickly the volume is picking up. I'm not a subscriber to that. However, I am a subscriber to, if I see a trend and I see a trend happening quickly, I would spread it off. So especially when those premiums get really, really expensive, we know it can be a home run, and by the same token, you can be right on your direction, let's say if you're buying calls and the stock goes up, but lose because all of a sudden that premium gets sucked out. So I am always going to spread that off, but I am not really a big subscriber into saying, boy, this could be the next meme-like situation, so I want to get into that or get ahead of it.
One of those that was really hot, NBIS, Nebius, that did the Meta deal, is getting creamed today, down 8%. That was like number 2 on the list of Wall Street bets, popular names we were looking at yesterday. So, I mean, it's certainly a little bit of a tiptoe, be ready for, whippiness. The same thing with MicroStrategy, Master, is at this point, I think the weakest chart in the market. I mean,
I agree with that.
Yeah, I mean, how does one argue that? Like, it's about to break new lows today. Almost
no, I
220.
agree. When you look at charts like that, and we go back to NBIS for a second here, if you're trying to discern something technically, fundamentally here, today it broke through the 50-day moving average. So I look at this, and as much as I may want to buy the dip, or someone may want to buy the dip, if in a stock like this that can get meme-ified, it was on Wall Street Bets, I've got to look at this and say, okay, where's the next level here being fundamental or level-headed that that from a technical standpoint, I want to dip my toes into? And it wouldn't be Oliver and NBIS until this big gap, which is down near the 65 level. I don't know whether it's getting down there or not. If I miss a move like that, then I miss a move like that. I don't want to get in front of that freight train. You're going to hear all the people out there that say, you know what, I bought the dip on this one. Great, you bought the dip on this one. That is fantastic. When it comes to MSTR, which is just, boy, oh boy, I don't want to say it's falling off a cliff, but you're right.
I mean, I got the chart back up. It does look like it's falling off a cliff.
This,
By the way,
this,
you know it looks steady as it goes, Scott? Sorry,
yeah,
you know it looks steady as it goes? NVIDIA looks amazing. NVIDIA looks amazing, and Master just falling apart. So to me, that speaks volumes. Sorry, go ahead.
No, it does. And when you look at Master on the chart here, if you widen that out a little bit, you look at this 228, 230 area that it broke through today. That had been really significant support going back earlier this year, March, April this year. Mm-hmm. So to your point of what you were saying earlier about prior support being resistance, prior resistance being support, this is going to be really, really interesting in Master. If we sell off a little bit more and then we get a rally back up towards 230-ish or so, is that now going to be resistance? Because I see that as some really big-time support that just got broken.
And they just tried it on Friday too. So I mean, this thing is on the brink. I'm not ready to go this route just yet because I'm happy enough that my long Bitcoin short micro strategy did so well this year. I was able to, I think, hopefully redeem myself somewhat in the eyes of the coiners who have hated my general cynicism, but that was kind of the idea, is just accept that crypto markets are supposed to offer you risk and understand that MicroStrategy is now the riskiest version. So that, I think, has helped Bitcoin outperform. That was the whole point of the long Bitcoin short Master trade, okay? It's basically an arb trade. But now, if Master, after acquiring, buckets of Bitcoin, has a major financial issue, and the stocks, or let's just say the stock starts crashing, okay? There's no way that's not going to bring down crypto overall. Come on, let's be real here. You know what I mean?
There's no question.
There's only so many people trading this stuff, and if their god suddenly falls to earth,
I mean, outside of the ETFs, this is the biggest proxy for it out there, probably, and knowing how much that they have accumulated, you're right. If there is even a hint or a taste that there's a liquidity crunch or they need cash or something, boom, you know where that is going. Do you mind flipping to a Bitcoin chart for a second?
Yes, sir.
Yesterday,
We're
as you know, and the reason I couldn't get on, I was actually teaching a markets class down at University of Illinois, where I went, and one of the students asked me to bring up a chart of Bitcoin because we were looking at technicals, and a 365-day moving average is not something we typically look at in the equities, but for Bitcoin or something that trades 24/7, it certainly makes sense. If you bring up a 365-day moving average, I don't know if you can there, we're sitting on it right now.
365, okay, daily SMA.
A one year moving average.
Okay, I'm cheating a little bit today and using Thinkorswim, so I can. All right, does that look close, Scott?
It is close, but not quite. There you go. Because we're sitting at it right now. At 100 to 101 is the support right on that. That 365-day simple moving average indicator for the last 2 years has been as spot on as any indicator I have seen in any equity or any sort of commodity over the last.
It needs to hold.
It needs to hold. There's no question.
I mean, I think a diagonal line serves basically the same purpose at this point. The diagonal line goes pretty similarly, through the old higher lows. So I mean, it's showtime, baby.
It is, and I thought maybe the bounce that we saw this morning, who knows what that was due from. But boy, this one is really, really strong. And if this doesn't hold here, if that coincides with what we're seeing in MSTR, and I am not trying to be doom, I am absolutely not trying to get the Bitcoiners out there angry with me. I'm just pointing something out.
Well, you're doing my show, so
you got some room to go.
They may be angry. No, I love the corners, and they love me. I think we're great frenemies. because my analysis of it has tried to be just very technical in nature on the chart. So I've been long Bitcoin in moments when it was breaking out, but my overall underlying cynicism, of course, is why I lean bearish if something like MicroStrategy were to really break down. I've got the RSI on the bottom panel here, the lower highs worked again like a charm. The bearish divergence just should be keeping coiners awake at night. So we'll see what happens to Master if it can hold these levels. Thanks for the perspective as always, Scott Bauer. Appreciate you, man.
Thanks, Oliver.
Thanks, CEO of Prosper Trading Academy, Mr. Scott Bauer. All right, we're going to come back, talk some AI and how AI is disrupting the world of portfolio management. Jack Lynch joins me from Ridgeline, who's teamed up with multi-billionaire David Duffield to try and use AI, and I think a way it's going to be relevant for a lot of people, whether it's advisors, PMs, traders, etc. We'll be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance.
Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. I'm joined by Jack Lynch of Ridgeline for a very fun conversation. It's going to hit everything from AI, how that's being used for portfolio management. We're going to talk a little bit of Cornell alma mater, because you are working with David Duffield, multi-billionaire founder of PeopleSoft, which was part of Workday, and now Ridgeline, which is I think doing something that seems like important. Maybe not low-hanging fruit, but fruit to grab for AI. So it's great to have you here, Jack.
Thanks for having me, Oliver, and so excited to be on your new Future of Finance show here at the Cboe in Chicago.
We're down in a very special spot because this is basically kind of the home of finding edge, doing something, finding a market for yourself. I'm kind of trying to do something like that for myself as well, doing the show. You guys are trying to find edge in probably the most competitive technological field right now, which is AI, but applying it to the financial world. So tell me about what you guys are doing.
Well, our genesis really starts with our founder and chairman, Dave Duffield, who you talked about earlier, who is a Cornell alumni like yourself, and Cornell has some incredibly accomplished alumni, including the 30 or 40 some odd that work at Ridgeline, and yourself and others, and Dave is that, as Silicon Valley, one of the all-time great entrepreneurs in enterprise software and technology. I like to think that if there were a Mount Rushmore of entrepreneurs to do the kinds of things Dave does, he might be on it with other luminaries like Larry Ellison and Mark Benioff, and Dave's a founder CEO that has actually, in a special group of a handful of only about 6 that have founded a company, taken it public, and then had it enter the S&P 500.
Yeah,
so
amazing.
He's got a special playbook. He's got a special network of talent that follow him. And he's got a special sort of set of core values that guide how he builds companies. We're intersecting that with the needs of global financial services at Ridgeline and serving our customers in asset and wealth management.
Okay, what is the main thing that can be automated away? I described it in a tweet as you guys are displacing part of the portfolio management labor or process. Is that a fair way to describe it?
Well, I wouldn't say the main thing to be automated away. When we first started Ridgeline, we went out and we looked for customers who believed what we believe. Because when you're an entrepreneur and you're starting something new, you really want to find those early adopters. So we looked for the ones that wanted to challenge the status quo in our industry and wanted to do that with a clean sheet of paper, because we've been afforded a clean sheet of paper. So when we asked them what the top business problems are that they wanted to solve, they really wanted to unify the systems across their clients, across their investments and their portfolios, their trading, their compliance, their reporting with their regulators. And they wanted to bring that all into a single system with a single database. And with a clean sheet of paper, that's the problem we attacked. With the talent that we handpicked to come on the Ridgeline team, that's ultimately the system we built. And that's taken us up to this point today where when we talk a lot about the potential for AI and how that's going to change software, we're now talking to our customers about how we can solve business problems in entirely new ways. And one of the unique things about AI is that historically, software companies like us, Oliver, have given our customers tools to do the job. So those could be trading tools, they could be portfolio management tools, they could be portfolio monitoring tools. We're going to deliver great tools. The cloud has made it possible for us to do that in a more secure, reliable, available way. But with AI, now the tools are going to be able to do a meaningful portion of or the entire job.
Okay.
And that's going to change software quite a bit.
Important context here is prior to this, you were at IBM and you were intimately closely involved with Watson.
Yes.
which was, you kind of look back on it, and I remember watching Jeopardy. It was a nightly thing in my house. When Watson came on, it was a real mind-blowing moment. IBM arguably kind of has lost maybe some of that to the, Gemini, the Claudes, all the stuff that's coming out. But that was the OG, AI in many, many ways, and I think many people today associate still, if they're above a certain age, AI with that breakthrough. So tell me about how that informs what you're doing today, your background with Watson.
Well, it was the OG AI. And when Watson was showcased on Jeopardy beating Ken Jennings and beating the world champions with an actual supercomputer, we all saw the potential of this technology for the first time. What I think I learned in that exact moment, Oliver, though, is the importance of data. The it in AI really is the data set, and you need an incredible data set to generate rich and accurate output with these large language models, which is why when we started Ridgeline with a clean sheet, we really focused on that single data set, right? And right now, our customers, before going to Ridgeline, have got duplicates of the same data, duplicates of records about their clients, duplicates of records about their trades. Having that really rich, robust data set is by far the biggest lesson learned from my experience launching the IBM Watson product. And we've really solved that now. And now that we have the data, and now that we have the power of these large language models, like from state-of-the-art models from OpenAI and from Anthropic and from others, I think the potential is really quite incredible, which is what's leading to the market to be so exuberant.
Okay, so
about this.
Tell me kind of some of the details about how it's made, the secret sauce. Where do you get the data from? Where you source the data from that you're using? Is that coming from a client that supplies you their data and you say, here's what we do with it, and we can combine it with the other stuff we've got from other clients, or what gives that pool of data that you're pulling from?
So inside the Ridgeline Unified Data Model, we bring in an incredible amount of data from our clients across their portfolios, across their compliance teams, their clients, their trades. We bring all of that proprietary data into a single data set. We augment that with market data from leading providers like a FactSet or a Bloomberg or an ICE or an LSEG. We bring in referential data, corporate actions data. We really sort of bring in data from a variety of different vendors and sources to really create a robust data set that ultimately becomes the rich data set for great AI output.
Is there a preferred AI that you see that kind of bridges that gap between what's relevant for a portfolio manager or financial professional, kind of what we're using casually? Like I kept bringing up Kalshi's estimate for the AI winner at the end of the year. Right now it's Gemini.
Is Gemini the winner?
Right now it's 80% the best at the end of the year. And that was very different if you look 4 or 5 months ago. It was much more neck and neck with ChatGPT, some of the others, and then Google broke away. I kind of called some of that because I have a Google phone and I saw how good it was. So there's kind of two questions in there, which is, one, how should people think about the AI you're deploying compared to maybe the AI they're familiar with using? What are kind of the core things that overlap with the financial world? That's the first part.
Well, right now, I think your audience should think about it as whether or not you're a model producer or a model consumer. So model producers are going to be your state-of-the-art large language model platforms, and there's really 5 big ones right now. There's OpenAI, there's Anthropic, there's Google Gemini, there's Grok, and those are organizations that are building out the state-of-the-art flagship large language models, and then software companies like us, we consume those models and we ultimately use them to create AI capabilities inside of our product experience. And so I wouldn't count Google out by any means. I think they were just reported this morning that, not this morning, but this month, that they're now processing 1.3 quadrillion AI tokens now, which is a number that I think they even said they sort of had to make up. And that has sort of gone up by a multiple of 100x in the last 24 months. Not 100%, 100x. So it's pretty incredible. I mean, if you think about the amount of time it took ChatGPT to reach 100 million users, which was about 2 months. It took Twitter about 5.5 years to reach that same milestone. It took Netflix about 10 years. So Twitter did that in 2 months. They're now at, OpenAI did that in about 2 months. They're now at about 800 million monthly active users. And so the growth is exponential and logarithmic in scale and nature, and I think that's gonna
at
really
this point
impact.
It still is like that.
Yeah, it really is.
There is, I think, a lot of things. To your point, it sounds like what you're doing first is helping people organize their data, make it cleaner, so that they know, right, to if you want to make good decisions, you got to have the right information. You got to have clean, good information. What about when I think about maybe finding edge as a portfolio manager and advisor? How does Ridgeline give that to me? Is it going to give me ideas for things? Is it going to cross into the realm of decision making on the investment side? Tell me about kind of where it might show up, manifest itself in a market way.
Well, I think that when you talk to a portfolio manager or an investment decision maker about AI giving you the ability to generate more alpha, you're met with a deep sense of skepticism. And so we don't believe that AI is going to start helping you make more money, but we think that portfolio managers and investment decisions are going to suddenly have and be augmented with a team of digital coworkers that they didn't have previously. So think of suddenly you have a team of CFAs, you have a team of research analysts, you have a team of people who are monitoring your portfolio, and these are all digital coworkers that are going to augment the brain power of the investment decision maker and the portfolio manager and really allow them, and I think it's a great time for your audience because a lot of your audience are firms of one, right? And they're working on platforms like the one behind us, they're working on platforms, emerging platforms like Robinhood, certainly they've used new consumer technology like at Coinbase. It's a great time to be an entrepreneur of one because suddenly you're gonna have this army of AI agents that are augmenting your capacity.
Absolutely.
And,
I've got some of them making some graphics for me. I got a few other ways to employ it that I definitely see. It sounds like my assessment of if you're a potential client, a user of Ridgeline, you maybe can think about it as labor displacement, right? Like it sounds like when you say kind of an automated person to help me with XYZ functionality, for a business of one, who's going to get displaced by that? Is it analysts? Is it our kids first year out of college going to have to figure out something else to do than run through a balance sheet?
Every time we've seen a technical loss.
Which, by the way, it's a terrible job.
Well, I would say every time
joking,
we've seen a technological revolution like this one, we've always reskilled. And right now there's an sort of incredible pendulum swing between the optimism and the exuberance for what this technology can do and the fear, uncertainty, and doubt associated with this technology. Just think about the last time you had a conversation about AI. You can go from one end of that spectrum in about 4 sentences.
Sure.
And so our message is choose the case for optimism. Time and time again, it is a much better bet to be optimistic. And
to embrace technology.
To embrace technology, whether it was steam engine or electrification or the modern computer or the internet. On the other side of all of these technological revolutions was ultimately exponential economic expansion.
Yeah.
And so when it comes
I think that's why the stock market is doing what it's doing. Like if you're a believer, this is the way it's supposed to work. And I'm kind of, giving the first year bankers a hard time, but like nobody really enjoys that job either. Especially if you have aspirations on constructing your own investment thesis, pushing the boundaries of what's possible in quantitative program or whatever it may be that you want to get to express your view in markets. It may be nice to not have to go through those first couple years of sort of analytical torture if you can ship it off to a calculator, basically.
So as long as you don't outsource the thinking in such a way that you don't understand the domain and the concepts with which you're going to have a core competency in. Ultimately, I think
you got to know how to
huge
where
premium.
a discounted cash flow comes from, even if you're not going to be doing it right. Like as a rudimentary example,
AI can be an incredible way to augment your craft. It can be an incredible way to bring out the very best in you. So as long as you don't outsource independent thinking to the technology, I think it's a pretty exciting time to.
Close me on, if I'm an advisor, portfolio manager, one of your potential customers watching this, how will I know if I need Ridgeline as a tool? How will I know that, okay, I need this? What are the signs?
Well, the signs are that you can't get a clear understanding of your business and you've spent an incredible amount of time trying to stitch all this together and use technology and data warehouses to bring it all together in one place, and you want to think differently and take a clean sheet of paper approach. And all of our customers are growing their businesses right now. In wealth and asset management, they're growing in private markets, they're expanding in alternatives, they're launching new strategies, they're launching new vehicles like ETFs. That growth, it creates complexity. It comes with that trade-off. And when you know you'll need Ridgeline is when you're ready to absorb that complexity with technology and for technology to be the ultimate leverage inside of your organization.
Who are you finding jumped on it first? Is it portfolio managers skewed to a certain type of investment or shop size or anything, just real quick?
Well, we're actually now at over $500 billion in assets cumulatively committed to Ridgeline. Okay. So a lot of people are jumping on with Ridgeline, and I think ultimately we're coming together to do it the Dave Duffield way, which is where you and I started the conversation, which is we've got a clean sheet of paper, we've got a long-term view, we've got a robust set of core values that guide us in how to build the company and the culture, and then we've got this technology paradigm shift. And when one of those things occurs, the world reorders itself, and a new disruptive entrant like us has the opportunity to serve the market in an entirely new way.
All right, well, Dave Duffield's got a pretty good background. Love your background with IBM Watson to augment it, and a successful track record and a beautiful building at Cornell, where I spent a lot of painful hours.
A lot of time.
In Duffield
Maybe
Hall.
playing some cards as well, though?
Not been yet, thankfully, or maybe not. I may not have been here. Great to meet you, Jack. Thanks for coming on the show.
Thank you, Oliver.
Jack Lynch, Ridgeline. Great way to close us out here for the major themes of the day. By the way, a quick little peek at the S&P 500 before I say goodbye. We did end at 68.50, below the key level, but we made it through. Appreciate you joining. I'll see you tomorrow, 2 p.m., 3 p.m. Chicago time.